Imagine this scenario. It's a Tuesday morning. You walk into your local coffee shop, and the barista looks exhausted. She tells you her rent just went up, gas prices are climbing, and she's picking up a second shift just to break even. She is the picture of economic anxiety. Then you open your phone, check the news, and see a headline screaming in bold letters, S&P 500 hits all-time high. There's confetti on the floor of the New York Stock Exchange. The disconnect feels almost violent. How can these two realities exist in the same universe? How can the scoreboard be winning while the players are losing? Hello and welcome. Today, we are taking a sledgehammer to one of the most pervasive myths in modern society, the idea that the stock market is a mirror of the economy. We're going to find out why it's actually more like a funhouse mirror, distorting, exaggerating, and sometimes hiding the truth entirely. I'm joined by Eloise, who has spent weeks digging into the mechanics of this relationship. Eloise, good to have you.
It is great to be here, Noah. And you're right, that feeling of disconnect you described, it's not just a feeling, it's a structural feature of modern finance.
So let's start right there. The stock market is not the economy. We hear economists say this all the time, usually when they're trying to calm people down. But what does that actually mean? If the economy is the engine, isn't the stock market the dashboard?
Not exactly. A better analogy might be that the economy is the engine and the stock market is a betting parlor across the street where people gamble on how fast they think the engine might go in 6 months. They are related, but they're looking at completely different things.
Okay, break that down.
The economy, gross domestic product, or GDP, measures what is happening right now. It tracks the value of all goods and services produced. It's the coffee you bought, the haircut you got, the factory floor running today. It's backward-looking or present-focused. The stock market, on the other hand, is entirely forward-looking. When you buy a stock, you aren't paying for what Amazon did yesterday. You are paying for the present value of all the future cash flows you think Amazon will generate over the next 20 years.
So the market is essentially a prediction machine.
Precisely. And that explains the divergence. During the COVID-19 pandemic, for example, we saw this vividly. In 2020, unemployment was sky high, businesses were shuttered, GDP had collapsed. The real economy was in shambles. Yet the S&P 500 recovered in record time and went on a tear. Why? Because investors weren't looking at 2020. They were looking at 2022. They were betting on the vaccines, the stimulus checks, and the rebound. They were betting on the future while the present was burning.
That feels incredibly callous, though, doesn't it? It feels like the market doesn't care about human suffering.
It doesn't. It cares about earnings per share. And here is where it gets even trickier. The stock market is not a representative sample of the economy. Think about your local dry cleaner, your mechanic, the local landscaping company. These small businesses make up a huge chunk of U.S. employment and GDP, but they aren't on the stock market.
Right. The S&P 500 is, well, it's 500 companies.
Exactly. And not just any companies, they're multinational giants. A company like Apple or Coca-Cola generates a massive portion of its revenue outside the United States. So the U.S. economy could be slowing down, but if consumers in India or Brazil are buying iPhones and Coke, those stock prices will go up. The fate of the U.S. worker and the fate of the U.S. stock market have been slowly decoupling for decades.
Okay, so they are decoupled, but they aren't totally separate, are they? If the stock market crashes, the real economy definitely feels it. There is a mechanism there.
Oh, absolutely. The transmission line between the two is what economists call the wealth effect. And this is fascinating because we can actually quantify it. The basic idea is simple. When people see their brokerage accounts go up, they feel richer. Even if they don't sell the stock, that psychological feeling of safety makes them more willing to spend cash from their paycheck on dinner, a new car, or a renovation.
It's the paper gains confidence boost.
Right. And the National Bureau of Economic Research, the NBER, has actually put a number on this. In a study by researchers Chodorow, Reich, Nenov, and Simshak, they found that for every dollar of increased stock market wealth, consumer spending rises by about 2.8 cents per year. That might sound small, less than 3 pennies, but when you apply that to trillions of dollars in market capitalization, it moves the needle on GDP.
Wait, so if the market goes up by $1 trillion, that generates roughly $28 billion in extra consumer spending?
Give or take, yes. It creates a feedback loop. Market goes up, people spend more, companies make more money, market goes up more. But, and this is a huge but, we have to ask who is actually benefiting from this wealth effect.
I suspect I know the answer. It's not the baristas I mentioned earlier.
No, the distribution of stock ownership is incredibly skewed. Data from the Federal Reserve consistently shows that the top 10% of American households own nearly 90% of all stock wealth. So when the market soars, the wealth effect is really a luxury consumption effect. It drives up prices for high-end real estate, luxury cars, and private tuition, while the bottom 50% of the population, who own almost zero stock, see very little direct benefit.
This brings us to a term I kept seeing in the research notes you sent over, financialization. It sounds like academic jargon, but the way you described it in the pre-show meeting made it sound almost like a disease, like something that has infected the economy.
It's a crucial concept if you want to understand why the economy feels so different today than it did in the 1970s. Financialization is the process by which financial markets, financial motives, and financial institutions gain authority over the real economy. It's when the tail starts wagging the dog.
Give me a concrete example. How does this change how a company behaves?
Okay, let's look at the behavior of the non-financial corporation, say a company that makes tractors or toothpaste. In the mid-20th century, the dominant strategy was retain and reinvest. You made a profit, you kept the money, and you reinvested it into better machines, R&D, and crucially higher wages to keep your workers happy.
Build a better tractor, hire better people.
Right. But starting in the 1980s, under the pressure of financialization, the model shifted to downsize and distribute. The goal became maximizing shareholder value above all else. So instead of using profits to raise wages or research a new product, companies started using that cash to buy back their own shares.
Stock buybacks. We hear about this all the time. Why is that the villain here?
Because it's financial engineering. When a company buys its own shares, it reduces the number of shares available. That artificially inflates the earnings per share, which boosts the stock price. It makes the company look more profitable without actually selling a single extra tractor. The Levy Economics Institute has published extensive research on this, showing how this transfers income from the real sector, workers and production, to the financial sector, shareholders and executives paid in stock options.
So the CEO gets a bonus because the stock went up, the shareholders get richer, but the factory floor sees no investment and wages stay flat.
Exactly. It explains the mystery of the last 40 years. Why worker productivity went up, but wages stagnated. The surplus value that workers created didn't go back to them. It was siphoned off into the financial markets. That is financialization in a nutshell.
That is depressing. But I want to pivot to the other half of our topic, politics, because if the stock market is siphoning off wealth, you'd think this would be the #1 political issue. Yet every president, Democrat or Republican, points to the stock market as their scorecard. Look at the Dow. I'm doing a great job.
It's the easiest scoreboard to point to. It updates every second, it's green or red, and it implies success. But the relationship between politics and the market is really messy. There's a myth that one party is better for the market than the other, but the data doesn't really support that.
I feel like I've heard that Republicans are better for business, so the market should go up, but Democrats spend more. So what does the history actually say?
Historically, the market has performed well under both. According to data analyzed by US Bank and Fidelity, the single biggest political factor the market cares about isn't who is president. It's certainty. The market hates uncertainty. That's why you often see volatility leading up to an election and then a relief rally once a winner is declared, regardless of who it is. They just want to know the rules of the game.
So gridlock is good?
Often, yes. A divided government where the president is one party and Congress is another is historically very good for stocks. It means no radical sweeping legislation is likely to pass, no massive tax hikes, but also no massive disruptions. It's the status quo, and markets love the status quo.
But politics isn't just about elections, it's about policy. And you can't talk about the stock market and politics without talking about the 800-pound gorilla in the room, the Federal Reserve.
The Fed is arguably more powerful than the president when it comes to the stock market. We saw this during the 2008 crash and again in 2020. The political response to a crash is almost always to flood the system with liquidity. We call this the Fed put.
Explain the Fed put.
It's a term named after former Fed Chair Alan Greenspan and later Ben Bernanke. A put option is a financial contract that protects you if a stock price falls. The Fed put is the belief among investors that if the stock market drops too far, the Federal Reserve will step in and cut interest rates or print money to save it.
It's a safety net.
It's an implicit guarantee. And this creates a dangerous political dynamic called moral hazard. If big banks and corporations know the government will bail out the market to prevent a depression, they take bigger risks. They leverage up. They buy back more stock. Because heads they win, tails the taxpayer saves them.
And this brings us back to the political consequences. If the government's main economic lever is save the stock market, and 90% of the stocks are owned by the rich, then government policy is effectively designed to protect the rich first, hoping the crumbs trickle down to the rest of the economy.
That is the critique, and we see the political fallout of that. When you have a recovery that is K-shaped, meaning the financial class shoots up like the top of a K, and the working class slides down like the bottom of a K, it generates massive political instability. Populism, polarization, the erosion of trust in institutions. Many political scientists argue these are direct downstream effects of an economy that prioritizes asset prices over wages.
It sounds like we've trapped ourselves. Politicians need the market to stay up to get reelected. The market needs politicians to keep the cheap money flowing. And the real economy is just caught in the middle.
It's a difficult cycle to break, but we are seeing some pushback. There's a growing movement to tax stock buybacks, for instance. The Inflation Reduction Act included a 1% excise tax on buybacks. It's a small step, but it's a signal that the political wind might be shifting away from pure financialization.
So, if you're listening to this and you don't own a single share of stock, why should you care? Why shouldn't you just tune it all out?
Because even if you don't play the market plays you. It dictates whether your company hires or fires. It dictates the interest rate on your credit card. It dictates the political mood of the country. You can ignore the ticker tape, but you can't ignore the gravity it exerts on your life.
That's the sobering reality. The stock market isn't the economy, but it has become the master of it. Eloise, this has been an eye-opening tour through the casino. Thank you.
My pleasure, Noah.
And thank you for listening. If this episode helped you make sense of the madness, send it to that friend who keeps checking their portfolio app every 5 minutes. They probably need to hear it. We'll see you next time.